Next, let us start with benchmarking. So benchmarking is one recognized method through which auditor determines the materiality level. So we know that in order to determine the materiality level, the auditor needs to exercise his professional judgment. So professional judgment means what? Will the auditor know everything? No. He will basically use some methods to establish a materiality level. So benchmarking is one very recognized method which the auditor uses to determine materiality level. So it is basically a method for determining materiality, and here percentage is applied to the chosen benchmark as a starting point in determining materiality for financial statements as a whole. So benchmark and percentage is chosen by auditor on the basis of professional judgment. So what are the factors which may affect identification of appropriate benchmark? So whatever these question marks are there which I put near the topics, so these are important topics and these topics have been tested. So what are the factors which may affect identification of appropriate benchmark? So the first factor is elements of financial statements. So assets, liabilities, expenses, revenues, equities, the elements of financial statements can affect the identification of appropriate benchmark. The next one is attention of users of financial statements. So whatever users of financial statements are there, their attention towards revenue, profit, assets. So attention of users financial statements will also be a factor. For example, see, a company is solely financed by debt. So if a company's capital structure is entirely debt, then the user's attention will be towards assets. So in case of it is financed by debt, then the bank loan that you take or the debenture holders, their attention will be towards the assets. Now, why will their attention be towards the assets? Now, you read this in law in the chapter named charges, that whenever the company borrows some amount, then it will secure the loan. The charge holders will basically have a right in the assets. Okay, so basically it will be secured by a charge. So that is the idea over here. Next, in case of a company is solely financed by equity, then the equity shareholders' attention will be towards net profits, because ultimately the equity shareholders will want their dividend that will come from the net profits. Next, the next factor is nature, life cycle, industry and economic environment. So the nature of the entity, the life cycle of the entity, the industry in which it operates, the economic environment in which the entity operates. So these are all the factors which also affect the identification of appropriate benchmark. Next, ownership structure of financial pattern, whether the company is debt funded or equity funded or there's a mixture of both. Next, the relative volatility of benchmarking. So what is the meaning of volatility? The tendency to change quickly. So initially when the auditor is devising his audit strategy, he will start making judgment and he will use his judgment to set a benchmark. He will use his judgment to set a materiality level. What is the tendency that it will change quickly? What is the tendency that the benchmarking will change quickly? What is the tendency that materiality level will change as the audit progresses? So these are the 4 levels. These are the 4 factors. 5 factors which mainly affect identification of appropriate benchmark. Now, examples of benchmarks. So the first example is reported income. So reported income can be profit before tax, total revenue or gross profit. Now in case of profit-oriented entities, if profit before tax is volatile, see, what is the objective of profit-oriented entities? The objective is to earn more and more profit. So every year the profit will sort of increase because they are driven to earn more profit. So in that case, it becomes volatile. It means that the profit before tax tends to change quickly. So in that case, you cannot choose profit before tax. In that case, you will choose total revenue or gross profit. Next, total expenses. The third example is total equity or net asset value. So these are basically the 3 examples of benchmarks which you need to remember. This can be tested in the form of an MCQ. Next, for example, when as starting point, the materiality for the financial statements as a whole is determined for a particular entity based on percentage of profit before tax. So for an entity, you are determining the benchmark level by using percentage of PBT, profit before tax. And there are circumstances which give rise to an exceptional decrease or increase in profit. The profit might increase, it might decrease, and because of which what happens? It means that the profit is volatile. So in that case, what you need to do? In that case, the auditor will conclude that the materiality for the financial statements is more appropriately determined through normalized profit before tax from continuing operations. Okay, so basically this example is elaborated over here. Next, what is the relevant financial data for benchmarking? So there are basically 4 things. The first one is prior period financial results. The second one is current period financial data up to the point of analysis. That is the most recent performance. Current period means when you are doing the benchmarking up until that date, the most recent performance. Next, budget or forecast for current period. And the third one is adjustment of significant changes. So what is the meaning of adjustment of significant changes? Circumstances of the entity. Because of the circumstances of the entity, there might be a need to adjust because of relevant changes of conditions of industry and economic environment. There might be adjustment. So these are the relevant financial data. You can remember it like the past, the present, and the future. Basically the budget or forecast for future. So prior period financial result, current period financial data, budget or forecast, and adjustment for significant changes because of circumstance of the entity or relevant changes of industry or economic environment. Next, determining a percentage to be applied to a chosen benchmark. So we know that once you set the benchmark level, you have to apply a percentage. So there is a relationship between percentage and chosen benchmark. Okay, so there is a relationship between percentage and chosen benchmark such that percentage applied to profit before tax. So whatever percentage that we apply to a profit before tax from continuing operations, it will be higher than percentage applied to total revenue. Generally, in general cases, whatever percentage that you apply to profit before tax from continuing operations, it will be higher than percentage applied to total revenue. Example, the auditor may consider 5% of profit before tax from continuing operations to be appropriate for profit-oriented entity in a manufacturing industry, while the auditor may consider 1% of total revenue or total expenses to be appropriate for not-for-profit entity. So basically, if it is not a profit-oriented entity, then you will use total revenue, and the percentage will also be lower. So higher or lower percentage, however, may be deemed appropriate in different circumstances. So as I already told you, the circumstances differ. So everything is not required to be followed as it is. Depending upon the circumstances, the auditor needs to exercise his professional judgment. Next, materiality level or levels for particular class of transactions, account balances, or disclosures. So factors that may indicate the existence of one or more particular class of transactions, account balances, or disclosures for which misstatements of lesser amounts and materiality could be reasonably expected. So for particular transactions, for particular account balances, for particular disclosures, we might assume that a lower level of materiality could be, lower level of misstatement could be material. So what are the factors which will help in determining that? So there are basically three factors. So where law, regulations, applicable financial reporting framework affects the users expectations regarding measurement or disclosure of certain items, like in case of related party transactions, remuneration of management, and those charged with governance. So where law, regulation, or applicable financial reporting framework will affect the user's expectations regarding these items, then in that case what happens is that for specific class of account balance transactions and disclosures, whatever your materiality level is below the threshold is also considered as, whatever your misstatements below the threshold is also considered as material. Now, the key disclosures in relation to industry in which they operate. The second factor is that whichever industry the firm is operating in, the key disclosures in relation to that industry. For example, research and development costs for a pharmaceutical company. So in case of pharmaceutical company, it spends a lot of amount in research and development. So whatever key disclosures are there are relevant in relation to that key disclosures in relation to the industry in which that entity operates. Next, whether attention is focused on a particular aspect of the entity's business that is separately disclosed in financial statements, like in case of newly acquired business. So an entity's business has many aspects. So if you are focusing on a particular aspect of the entity's business, that is separately disclosed in the financial statements, like in case of newly acquired businesses. So these are the three factors you need to remember. Now the next topic is revision in materiality level as the audit progresses. Now we understood something that while devising the audit strategy only, the auditor will exercise his professional judgment and he will set a materiality level. Now this materiality level can be revised later. Why? Sometimes there is a need to revise as a result of change in circumstances, new information, change in auditor's understanding of the entity and its operations as a result of performing further audit procedures. So when the auditor is performing further audit procedures, sometimes he thinks that his understanding of the entity will differ. It will change slowly. Then in that case, what happens? The materiality needs to be revised. So if during the audit it appears that actual financial results are likely to be substantially different from anticipated period end results, actual financial results and anticipated period end results are actually differing, then in that case the auditor will need to revise the materiality. So basically, if the auditor concludes that a lower materiality lower materiality for the financial statements as a whole than the initially determined materiality level is appropriate, then the auditor should determine whether it is necessary to revise performance materiality. So we understood what is performance materiality. If the auditor will conclude that the lower materiality for the financial statements as a whole than initially determined, then he'll have to revise his performance materiality. And whether the nature, extent and timing of further audit procedures remain appropriate or not, he has to check. So basically, the materiality level can be revised. That is what this topic is telling about. This can also be tested in the form of question. It has already been tested. Next, documenting the materiality. So this is the most easiest part of this entire chapter and also the most asked question. The first one is, see, when you're documenting the materiality, what all you need to include? The first thing is materiality for the financial statements as a whole. Okay, so basically materiality for your financial statements as a whole is nothing but your overall materiality. Okay, then if applicable materiality level for particular class of transactions, account balances, this is your specific materiality. Then we have something known as performance materiality. And lastly, any revision as the audit process. Basically, you have to document the types of materiality and any revision in them. Okay, next, materiality and audit risk. Now, the concept of materiality is applied by the auditor in both planning and performing the audit. So right from the planning stage, he will start applying materiality, and throughout the performance of the audit, he will use the materiality concept. And he will also use materiality concept in evaluating the identified misstatements and uncorrected misstatements. And he will check whether the financial statements as a whole are free from material misstatement and whether the financial statements are prepared in material respect. So basically, this entire thing is chapter 1 ka basic information that they are pasted over here. Okay, so audit risk is the risk the auditor expresses inappropriate opinion of financial statement. So this is the risk definition that we have already read. The main thing over here that you need to remember is these 3 points. These 3 points are also easy. Materiality and audit risk are considered throughout the audit. In particular, when are they particular? They are considered throughout the audit, but in particularly when they are considered particularly when identifying and assessing risk of material misstatement, determining the nature, extent and timing of further audit procedures, and evaluating the effect of uncorrected misstatements. So this part is easy. This part is easy. Now this part you need to remember a bit. Evaluating the effect of uncorrected misstatements, if any, on the financial statements and forming opinion. Now, so we are done with the chapter. Let us check this incorrect or correct statement. Okay, there is a direct relationship between materiality and degree of audit risk. Is it correct or incorrect? No, this statement is incorrect. Okay, so why is it incorrect? So we've already discussed this. I'm going to show you the solution. See, there is an inverse relationship between materiality and the degree of audit risk. The higher the materiality level, the lower the audit risk, and vice versa. So this statement can be specifically understood with the example of performance materiality. So we have seen the example of performance materiality, that when the risk of misstatement is high, when there is high risk of misstatement, your performance materiality level will be set to a lower level. Okay, when there is low risk of material misstatement, your performance materiality level will be set to a higher level. Because the risk is very low, that's the reason you're setting it to a higher level. So basically, what is the relationship between them? Higher the risk, lower the performance materiality level. Lower the risk, higher the performance materiality level. So there is an inverse relationship. Now this correct and incorrect statement, they have said that there is direct relationship, which is completely wrong. It is incorrect. So we are done with essay number 320. Okay, so we are done with this standard.